Hello and welcome to the newest edition of The Market Lens. I'm Sam Rozzi, the manager of Due Diligence, and I'm joined here by Cliff Walsh, our Chief Investment Officer. If you're not up to date on the previously released Market Lens, please check them out at Studio 454 or on YouTube. Today we'll start our show off with a news or noise segment on the earnings season. Earnings season is in full swing, and we've had a surprising number of beats mixed with rising analyst estimates. Analyst estimates have risen much more than history. Do you think this is good news for bulls, or is this just noise?
I'm going to hold off on giving you my answer, but you are very perceptive. 85% of the S&P 500 companies that have reported earnings as of last week have beaten their estimates. The long-term average is closer to 2/3. What's interesting to note is that half the companies that are beating estimates are seeing their stocks drop. Valuations are high. There's a lot priced into this market, as we discussed last episode.
So what companies are beating expectations? Are any specific sectors or thematic areas outperforming?
The upside surprises have been somewhat surprising. A higher percentage of secular growers are outperforming estimates, 96% to cyclicals at 78%, which is not necessarily what you would expect at this point in the cycle, but the beats are much smaller there than the cyclicals, 14% upside to close to 50% upside with the cyclicals, which is much closer to what you would expect to happen with the economy reopening. In terms of industries, financials have been the big winners to the upside, while airlines have come up short. Not too surprising, given the financial market activity we've seen so far and still lack of travel going on. Expectations are rising throughout this season, as you mentioned, with estimates up 7% on the heels of all these beats. I expect the upside to be muted from beats throughout the rest of this earnings season.
With estimates moving upwards as we've seen earnings come in ahead of expectations, what are your predictions for next earnings seasons or the remainder of 2021?
Estimates have risen 7%, as I mentioned. I think the second quarter, is a bit of a crapshoot. If you recall, last year's second quarter saw GDP down 33%. Earnings in the S&P were actually down a little bit more than that. Estimates are looking for a 55% uptick in earnings, this year for Q2. Is that on target? I think we'll see. I think it's probably some upside, but it's tough to say just how, given how horrible the comparison quarter was. Consensus expects 20% growth in Q3, 15% in Q4. Those aren't in the bag by any means, especially given where the current employment situation is. Even if corporate America beats these numbers, history shows that when earnings estimates imply growth of 20% or more, the market is flat to down in the following year. So we could see a bit of a pullback or a choppy market for the rest of this year and into next year. So I think the market's reaction to the earnings beat is news, but despite the earnings upside, I think it's not good news for the bulls.
Understood. Thank you for the color on the earnings season. Now we'll zoom into the market lens and focus on thematic investing. Last episode, we discussed that equities are trading at very high multiples when comparing to history. You said a rising tide would and has lifted all boats, but now you believe we're closer to high tide. Do you think thematic investing is the answer to finding value at this point in the cycle?
I think they are. As I mentioned last episode, I think there are going to be sectors that will work, namely cyclical and value-oriented, and sectors that won't, namely those that have benefited dramatically from the stay-at-home trend. But I think one of the best ways to outperform is to look at smaller slivers of the market, like industry groups and themes. The best way to access would be ETFs that are grouped by common elements or drivers like clean power, pet care, home construction, cybersecurity, to name a few examples.
Our theme catcher model has recently rotated from thematics such as genomics and into more infrastructure-related plays. What areas of the thematic universe have done well, while what has underperformed in 2021?
In the past 6 months, there's been a wide range of leaders, which I think highlights the importance of taking that X-ray look into the sectors and broader indices and looking at those themes. Uranium mining, data sharing, travel technology, cannabis, sports betting, 3D printing are at the top of the scoreboard. AI and deep learning is an underperformer over a whole host of time frames, but has started to percolate a little bit in the last month or two, so it might be a good opportunity for some more research. We're just scratching the surface of the long-term potential and emergence of AI and deep learning. Those ETFs with Chinese internet exposure, also medical players focused on breakthrough technology, have also been lagging, but seemingly have long-term investment potential.
So how does the average advisor fit these high-flying thematic ideas into client portfolios? Are they suitable for everyone?
That's a good question. I think, given the active share and volatility of some of these areas, I think it's best to think about position sizes more like you would for a stock rather than a broader index. Diversification of themes is also important, and I think you also have to be very clear as to why you're buying them and what the exit plan is. It could be your typical fundamental strategy focused on outlook, valuations, and catalysts, or if you just want to chase the best performers, that's fine, but you should have trailing stops or some sort of technical system to sell. Our theme catcher strategy uses momentum. We wanted a system where we wouldn't have to fundamentally identify winners. We would catch the themes on the way up as momentum accelerated and then get out as momentum waned. We also use defense as a theme, so when the broader universe of themes is weak, we have potential to make money in down markets. If advisors want access to the growing thematic universe but aren't stock pickers, don't have the time, theme catcher is a great option, but do-it-yourselfers can have success if they put in the time, have an investment philosophy, and stick to it. Either way, themes are becoming more and more important in the market as more options become available and market participants become aware of them. In tough markets, in markets with high valuations like we have currently, themes can be a part of the solution rather than the problem.
Thank you, Cliff. My dealings with AP advisors, I've seen a large increase in demand in different types of investment ideas, and I believe thematics fit the bill. We hope everyone really enjoyed this episode of The Market Lens, and we look forward to seeing everyone soon. We hope this is letting you see 2020. Thank you.
Thanks, Sam.